Notable for market crashes. We saw one in 1929. We saw one in 1987. But according to Bespoke Investment Group, the Dow averaged an increase of 0.5%. And the Stock Traders Almanac says that the S&P 500 usually averages a gain of 0.8%. So it's not all bad news, except for those 2 years we all remember. Since 1950, it ranks as the 7th best month, while in the past 10 and 20 years, it ranks as the 4th best. Will this year be any different with Fed tapering on the horizon? Let's get right to our floor show. I've got Thomas Hayes and Larry Schover with me. And Larry, I do always like to look at history because there have been some huge market events that some we were alive for and some we were not, Larry. But as we move into the fourth quarter, is there reason to be optimistic?
Yeah, I think there's always a reason to be optimistic. And I think trying to predict the next market crash is just kind of a fool's game instead of preparing for it. But that said, I think U.S., we know what's going on right now. We know the unemployment scene is struggling a little bit. Eurozone right now with inflation. But I think the story people aren't talking about is the severe slowdown in China. So with their economic data, so that could rain on our parade in October, but right now I just don't see it happening.
Thomas, I got to say here, the S&P, for the week at least, was having its worst week in about 8 months. NASDAQ not doing much better, kind of in line, and the tech story has been unfortunate. What we have seen today, at least, is some of this buying on the dip. But overall, it seems the reopening trade had kind of stalled for the month of September. Having said that, you've got this great news on Merck today and their COVID treatment, which is basically like Tamiflu for COVID. And then you've also got the fact that the cases are going down and the average daily death rate is going down. Doesn't this give you a sense that the broader economy is going to pick up steam?
Yeah, Cheryl, I think with the Merck pill, with global cases going down, and with the Fed signaling taper, which means we're going to be in a rising rate environment through the end of the year, I think we're going to see the leadership mantle change from tech and growth over the summer back to cyclicals, reopening, and value like we saw in Q1 and Q2 of this year. And in that context, we want to get exposure to those sectors that have fallen out of favor over summer. We like Wynn Resorts. If we saw the Macau gaming numbers over the weekend, they were up 32.4% month on month, September versus August, which is pretty exciting. The stock has been down on fears that their license and concessions won't be renewed next year. But if you look under the hood, local partners own 28% of Wynn Macau. So I think those fears are overblown because the government's not going to hurt the local partners. And then you're seeing the booking trends in the U.S. pick up, plus their digital platform for gaming and for sports betting has a long runway ahead. And then we want to look at Lockheed Martin. Industrials and aerospace fell out of favor this summer. It's off 15% off of its highs. It's going to earn 27% more next year than it did pre-pandemic, and yet it's 18% off of its pre-pandemic highs. It's trading at about 12.5 times next year's earnings, and you get a 3.25% dividend yield while you wait. So
a lot to unpack there. A lot to unpack. Larry, go ahead.
One of my all-time favorites continues to be is J.P. Morgan. I mean, I know it's up 30-something% on the year, but the whole sector has stuttered recently, just because of the thought that maybe capital market revenue won't be as strong as they first thought. I think it's trading at a discount, given the fact that J.P. Morgan has the strongest, or if one of the strongest, investment bank franchises on the planet. It tends to lead in loan growth, and let's keep in mind, loan growth has not been that good this year. So I'm not too surprised J.P. Morgan's up as much as it is. People have been relying on savings, but I think loan growth will start to expand as we get into the end of the year. And best-in-class technology, being able to market to the average investor, the average bank person, and the most complex deals on the planet.
Right.
So when you think of a PE of 11, yield of 2.4%, I still think it's a good buy.
Yeah, no, I hear you. And by the way, we got to run. But, Lori, to your point here, if you do have a higher interest rate environment over the next several months, and I mean, come on, it's going to happen. We can't really, avoid that now. That's good for the banks. And I'm sure they're going to talk about that when earnings start to trickle in a couple of weeks. Tom Hayes, Larry Schover. Guys, great to see you. Great picks from both of you. Thank you. I was taking notes the whole time. I wrote it all down. All right, well, we've got some